In this video, I'll describe term and permanent life insurance policies and tell you which is the smarter choice. And we're starting right now. Hey guys, Elliot here. So we all know what life insurance is. It's a simple concept. You open a policy, make payments, and if you die, a beneficiary, usually your close family, receives money. This basic idea of how life insurance works has been the same for nearly a century. It was also about as straightforward a financial decision as you could make, and an important one too. If you were the primary earner in your household with your spouse at home raising kids, and you suddenly got hit by a bus on the way home, having a policy meant that the loss of a major source of income would not further devastate a family already dealing with the death of a loved one. It was certainly a topic no one wanted to think about, but if you had family and a mortgage, it was a no-brainer to get coverage, and for years it was simple, fast, and cheap to do so. But of course, if there was a financial benefit that was simple and cheap, someone had to come along and make it complicated and expensive. Because, you know, profits. And thus, the simple term life insurance policy was joined by a number of permanent ones, and those had a bad habit of ballooning in price and complexity. With that in mind, let's take a quick tour of what is out there, and in the end, I'll make some really important recommendations that could save you a ton of money, so definitely stick around. And if you enjoy this content and want to see more of it, please do subscribe and drop a like. So to keep it brief, there are two kinds of life insurance out there: term policies and permanent policies. How they work is easy to guess from the name. A term policy is one that covers you for a certain term, such as for example 10 years or 20 years. During that time frame, if you die, your beneficiaries will get money. This type of insurance is very cheap if you get it while you're in your 20s, 30s, or 40s. It's more expensive in your 50s and 60s, and a lot more expensive if you're in your 70s and 80s. The reason for this is very simple. Odds that you will die are very low when you are younger, but increase dramatically as you get older. Thus, the death benefits and by extension the premiums will increase greatly with age. Fortunately, in most cases, you don't really need life insurance when you're much older, as hopefully by then your house is paid off, your kids are all grown up, and you have extensive savings from a lifetime of working that will be enough for your spouse to live on if you die. You also don't really need coverage when you're in your 20s, as you likely aren't yet married, have kids, or have a mortgage, and if you die, no one will really care. I'm totally joking. What I really mean is that you don't yet have obligations and dependents who will need the payout, thus no real need to have a policy. Term insurance is very easy to sign up for. You find a solid insurance company, pick the policy term, let's say 20 years, select the amount of coverage, let's say $500,000, and then just make payments, which could be as low as $25 to $50 per month, and that's it. If you die in this 20-year time frame, your beneficiaries get the full policy payout tax-free, but if you outlive your policy, you unfortunately get nothing, as that is the flip side of term policy agreements, and yeah, it's a bit of a downside. Okay, with me so far? Good. Now that we got term policies out of the way, let's talk about permanent ones, and here things will get weird, as these are the new kids on the insurance block, and they come with some peculiar and costly features. Permanent life insurance, just like the name says, covers you for life, not just for a limited term. That means if you live until age 90, you will be covered. Now this sounds good on the surface, right? Well, here's where it all goes off the rails. As I just mentioned a minute ago, insurance policies get extremely expensive as you get up there in age. As a matter of fact, if you're 80 or 90 years old and have $1 million policy, well, the insurance company will be on the hook to pay out $1 million pretty much any time now. Now, obviously, they can't stay in business for very long if the premiums they collect are less than the payouts, so as you get older and a step closer to the Grim Reaper, the premiums will grow astronomically. With term life insurance, the way to deal with that is to not get it after a certain age. But what about permanent policies? How do they deal with this? After all, you can't charge someone $50,000 per month for premiums. Well, the first way permanent insurance gets around this is by being quite expensive while still being affordable from the very beginning, so you can build up equity in the policy right away and keep building it for years to come until you get old. That alone, however, isn't enough, so the second way the policies deal with the spiraling costs is to to invest part of your premium so it grows over your lifetime. This is similar to a 401k, and it does go a long way to help offset the cost down the road when things get even more expensive. The part that gets invested is called the cash value of the policy, and all permanent insurance has this feature, as you can't really sell affordable permanent policies without this. The only major thing that changes between all the available types of permanent insurance is how exactly the insurance company invests your money. The oldest and best known of the permanent policies is called whole life, abbreviated as WL, and the investments there are typically quite conservative, sticking mostly to bonds. The three other major types of permanent policies are called universal life, or UL, variable universal life, or VUL, and indexed universal life, or IUL. These three invest in equities such as stocks and mutual funds and feature a number of variations on roughly the same idea. Now, I won't go over the minute details of the four permanent policies I just listed, as it would take quite some time, and I really want this to be an overview and a recommendation video. So with that in mind, let's get right to the conclusion and the bottom line. And the bottom line is that permanent policies are really not a wise choice for the majority of people. First off, in most cases, as already mentioned, you do not really need permanent coverage. Second of all, permanent policies are extremely expensive. Where a typical term policy may average somewhere in the $25 to $50 per month range, a permanent one may be in the several $100s per month or more, depending on age, gender, and other factors. Finally, it needs to be mentioned that while the idea of investing within an insurance policy seems like a good idea, it's actually not. And financial advisors stress that you should keep your insurance and your investing separate. The reason is that there's no free lunch, and your returns will be lower if you allow the insurance company to invest your money. There are extensive fees and floors and ceilings to contend with, especially with a policy like an IUL, and you are far better off investing your money on your own or with a money manager. When it comes to insurance, it does pay to adhere to the age-old conventional wisdom of buying a cheap term policy and investing the difference, or in other words, investing the money you would have spent if you bought a permanent policy. Now, permanent policies do make sense for certain high net worth individuals who can build what is called a corridor, which is just a sweet spot where your policy is well funded, but not so much that the IRS considers it an illegal tax shelter. You can then take out tax-free loans against the policy's equity. Such funding, however, takes a lot of money to get to and is simply not worth it for the middle income folks who would be much better served with a term policy and an investing portfolio. For them, overpaying for a permanent policy makes little financial sense. Okay, I hope you learned a lot about life insurance in this short presentation. It is an important topic, and you do need to have it to protect your family. But that doesn't mean you need to get ripped off. Get an inexpensive term policy and stay away from the expensive permanent ones. Please do like and subscribe. It helps me out a lot, and I will see you all in the next video.